Hello, everybody. Josh Brown here, back for another great episode on Franchise Euphoria. Well, today's episode is brought to you by IndieFranchiseLaw.com, a leading resource in the franchise space to help you if you're considering buying a franchise, turning your business into a franchise, or growing your business through a licensing or franchise structure. So go on, check it out, IndieFranchiseLaw.com. I think you'll find a lot of valuable and free information as you continue to kind of weigh franchising and licensing and the growth of your business. Without further ado, I hope you enjoy today's episode. So in today's episode, I have Tab Burkhalter, who is the managing partner of the Burkhalter Group located in Tennessee. And he's a CPA, he's a lawyer, and he deals with franchise systems. And so today we're going to be talking to him specifically about financial and tax implications of opening a second franchise location, as well as exit strategies for franchise owners. And we're going to be talking about both topics from the perspective of the tax implications. I often get these questions. I think this is prevalent for both franchisees and franchisors. And I think you'll find with Tab is that he is very knowledgeable, very down to earth and plain spoken. It's a wonderful interview, and there's some real insight into tax implications that you need to be thinking about at the outset of your franchise endeavors. So without further ado, here's my interview with Tab. Hello, Tab. Welcome to Franchise Euphoria. How you doing?
I'm doing great. Thank you for having me today.
Well, I'm particularly excited to have you on the show today because we're going to talk about two specific topics, that being financial and tax implications of opening a second franchise location, as well as exit strategies for franchise owners, which are two really hot topics and pervasive topics in the franchise industry. But before we get there, why don't you tell the folks a little bit about yourself?
Sure. I am a licensed CPA over in Tennessee. I also have a law degree, and I have been in private practice since 2002, but I started working in the CPA world and franchises specifically when I was in the seventh grade. My dad is a CPA and a tax attorney for a lot of Shoney's franchises. And so at 7 years old, most kids would go on a spring break. I spent mine doing tax returns and bookkeeping.
Oh, that sounds awful, Tab. Spring break sounds much
would have
better.
been much better, but I spent most of mine with dead animals inside of the tax folders that they want us to give the revenue agents.
Oh my gosh. Well, that's a good education though.
Oh, we have learned through different franchises as well as just over the years, some of the different tricks that we have learned, and really where a lot of I'm going to say restauranters, I like to hide a lot of stuff, which is just in garbage bags full of receipts. And I swear, I think they pull them they go around at night and raid everybody else's garbage cans because they say, oh, we need 30,000 more receipts. Here you go. Here's some more receipts for you. I don't know where they came from, but we're going to use them. So.
Wow. So you guys mostly do work with restaurants?
We do work with restaurants. We have done some in the car franchise industries, but I'd say about 80% of our work is in the restaurant side.
Well, and whereabouts in Tennessee are you?
I'm over on the East Tennessee side, a little city south of Knoxville called Maryville, and then our other office is in Nashville.
I love Nashville and the whole Franklin, Brentwood area. I know lots of people there and been there countless times because I'm located in Indianapolis, so it's not too far of a jaunt down there.
No, it's not. Franklin and Brentwood has just really grown up. Our office is actually over in Berry Hill, which is on the outskirts of Brentwood. You go right by our office when you go down 65.
Oh, wow. Well, so I'm fascinated to have you on because obviously you've got a great background being both a CPA and a lawyer. I always like talking to other fellow attorneys, myself. So it's always nice to do that. But I love the experience in the franchise realm. And, as I'd mentioned at the outset, one of the things that I often get asked about is tax implications, financial implications of opening a second, third, fourth, and beyond a franchise location. I mean, these are things that are of the utmost importance to franchisees and franchisors alike. And I'd love you for you to comment on that and maybe in your experience, highlight some of the things that you see that people do right and some of the things that may be cause for concern.
Sure. I think the first thing is when you start looking at, are you going to open up a second location, is asking the question, are you going to run it through your existing company, or are you going to open up a separate company to where now then you have, I'm going to say, two independent corporations that you're doing work for? We ran into a situation. It's not a matter of taxes, but more of a liability protection, to where one restaurant was operating, had above board profits, was doing really strong. The owner decided to put a second restaurant, but kept it underneath the same corporate identity, and the location just tanked. Couldn't explain it. The demographics all measured strong, but the location itself just never made any money. And he wound up losing both locations because the way that the agreement was written, the failure of one brought down the one that was the star. So what we look at is there a purpose that the franchisor has in wanting you to consolidate multiple locations underneath one entity, or can you set up separate companies so that way each one is insulated from the activities of the other?
And the idea being, if you've got two separate locations in your example, and one location's an all-star and the other you think's going to be an all-star, but you're not sure. Regardless, in business, you can never predict the future. You can try to plan and plot and do the best you can to achieve what you hope to be the future, but you never know what lies ahead. And if you're now combining these two businesses into one, what you're essentially doing is you're putting both at risk, as opposed to separating them out by having them operating under two separate companies, most likely an LLC, right? An LLC or an S Corp or something like that.
Correct. Most of the time, we like to put them into limited liability companies, those LLCs, and then elect to have them taxed as S corporations normally. We figure that gives us the best liability protection, but also gives us the best tax advantages for those franchises.
Yeah, because if you're taxed as an S Corp, but you're set up as an LLC, then you save on the self-employment tax. Is that right?
Exactly. The LLC is just really is a state created entity. The federal government says you can be an LLC, but you still have to choose how you're going to be taxed. Are you going to be taxed as a sole proprietor? Are you going to be taxed as a partnership? Are you going to be taxed as a S corporation or as a regular corporation? You still get to pick and choose, although you're an LLC. And a lot of people just overlook that. They feel like that if they're an LLC, they still have to be taxed as a sole proprietorship, which is not true.
Yeah, no, that's really good. That's really good advice. Once you've established or figured out how you're going to set this up, right, as you're going to expand. So you're thinking, okay, I'm going to expand. Let me figure out the vehicle under which I'm going to do it. Then what's the second consideration?
So after you've set it up, then you start saying, okay, is there any benefit for it to be isolated, for them to be insulated from each other? And almost always, there's never an overriding reason to combine. I always recommend you insulate activities from one location to the other. So then you set up that second location and you start getting into, or we're going to be hiring different people. There's going to be a different clientele because every location is unique. And because of the people that you might be hiring at a location might open you up for new tax credits or tax incentives that your first location may not have offered because of its location. There are certain areas where they're like urban blight zones where if you go in and set up a franchise or a new business operation, that the government gives you incentives for hiring people in those areas if you are deemed to be a new company. So that's the second consideration, is what tax grants or what tax incentives are there for where you're putting your second location. And what do we have to do on the formation side to put you into the best position to take advantage of those credits?
Now, how do you one practical question that I get asked a lot, I'd be curious your thoughts on it is, a lot of people who are considering a second or third or fourth location, whatever the case may be, another location for their franchise. Sometimes there's expenses that they spend, there's money they spend in doing that research. And if they subsequently then set up a separate company, can they run those expenses through that company even though they really spent that money prior to setting up the separate company? Does that make sense? I mean,
Yeah.
and does that benefit them?
All right, so the government recently, and I cannot remember the case that just came out, basically was talking about a person that was spending a lot of money for a business, but had never gone the route of actually setting it up. And could he still deduct the expenses? In your situation, you've already got an ongoing business. And now that you're looking at opening up that second location. So, yes, those expenses are deductible. What you run into is how do you classify and book those expenses? Do you view it as a loan from your existing company to you personally as the owner? And then you turn around and do that as a capital contribution into company number two. And then company number two records those expenses as your organizational costs and startup, which you have the legal right to expense once you start the company up and going. And so at that point in time, it's just more of a matter of what your consistent policy is and strategy is for those new market locations, for when you're what steps you're going through to analyze a new location.
I think that's great. That's one of those like practical things that people run into a lot where they're just not quite sure what to do. I think probably, and again, I'm not a CPA, but I know that obviously you just want to make sure that you're not trying to deduct it both ways, right? You're
Right.
not trying to get a deduction from both companies.
No, you get so we have got a client that does a lot of. He's not a franchise, but they do residential real estate developments. They'll go in, buy a tract of land, do 200-300 homes at a time. Well, one of the things that we do is when we do a new development, we'll set up a new company, but we keep a master company, kind of like a parent LLC, who does all of the research for different land sites. And then that company turns around and sells its findings to the new LLC that gets formed for going on plot number 8 or plot 17 or land, whatever land purchase we did. So we let the parent LLC that owns all of the subsequent baby LLCs underneath it incur those expenses. That way they're being deducted, and we have a very clean history for how we're doing it. So if you're looking at opening up a second franchise location, what we'd actually do is actually create you a total of 3 LLCs. One parent that owns the 2 baby locations, and then that parent LLC can deduct the expenses for all the site location work, the demographics, the market, because you might spend 18 months looking at the next possible location.
Well, that's right. I mean, that's a great point, especially in franchising, where when you are looking at another location, now you've got a whole set of legal documents you got to review again for that subsequent, even though you're already part of the system. Let's say you've been a part of the system for 5, 10, 15 years. Well, now there's going to be an updated FDD, updated franchise agreements. There's going to be some due diligence that you have to go through. There's going to be costs associated with that. I like what you're saying because part of the concern that I think sometimes people have is they just don't want all these random LLCs or companies set up that have no direct tie to one another, not only from a management perspective, but just from a tax perspective too, just in terms of getting tax returns every year and so forth. So I sort of like the parent subsidiary kind of model you're talking about.
Yeah, and the nice thing about that is when you do get in the new franchise agreements, we ran into one where the company allowed all of the original groups in to keep I think it was like a 3.5% royalty fee. All the new franchises that were coming in after that, they had raised the royalty fee up almost to 5%. And we're like going, okay, with the new location that we're getting into, we don't want to mess up what we have with the old agreement until that franchise term expires. So we had the separate ones set up, and in a way it went. But you're right. I mean, you start having to review just because you have one franchise doesn't mean that the second one's going to have the exact same parameters. They can change those documents. They just have to give you a little bit of notice, and everything is in the wording of those agreements. When they define gross royalties, and we were involved with one with a car manufacturer, or not manufacturer, but car repair shop franchise, where they defined sales as a preset. So even if somebody brought in a vehicle and they wound up just changing a windshield wiper blade, that was $5. Every car that came through that was touched had an immediate $65 minimum royalty tax on it for the calculations. And so you have to start looking at the fine print as to how they define calculations and revenue. And a lot of people overlook that when they start going to their second or third location. They said, well, I know the agreement. It's been good for me on my first one, but now that we're 5, 6 years in, the franchise has also developed more refined skill sets along the way.
So it's obvious from this conversation that there's lots of things to consider. It all depends in large part on the type of franchise, the type of business, the specifics of the relationship. But the point is, I think, for purposes of this interview with regard to what you need to look for is it's important to have a CPA on your team, who's helping you through that process because it can make a big difference from a dollars and cents perspective, not only on how you expand, but on making sure that you're getting the proper deductions, that you're doing it the right way, and ultimately save you a lot of money in the long run.
Correct. And I think the CPA also has to understand some of the terms inside of that franchise agreement. Just because the franchisor says that certain expenses are allowed or not allowed for calculating profit splits or other calculations doesn't mean that those expenses are not deductible on your tax return. And that's an important difference, is having someone knowledgeable that understands that this is your income calculation for your franchise agreement. That's got nothing to do with your tax return. The two are two completely different documents, and making sure that every dollar that you are able to capture that's an expense will normally save a franchisor 35 cents. So if you are able to reallocate $1,000 throughout the year of money that was spent out properly, reasonable and necessary for the operations of your business, that puts $350 back into the pocket of the franchise, of the business owner. And that's a good chunk of money.
Oh, sure. So let's go to the other side of the equation now and look at somebody's exiting a system. Okay, let's say they're part of a system. They've either, they may have multiple locations. Perhaps they're even the franchisor. Maybe they're just exiting. Maybe they're retiring, passing it on. Certainly, there's lots of considerations from a business succession perspective, that would involve estate planning and all that. But for purposes of this interview with you, what are some of the things that franchise owners should be thinking about, and franchisors alike, when they are leaving their system for whatever reason? I mean, what are some of the biggest tax implications to at least be thinking about?
Well, and that's an excellent question. The first thing is when you start planning your exit strategy, if you're the franchisee, is understanding what terms your franchisor has for change of ownership. You've got to make sure that if you're either selling a geographic territory or if you're selling a specific location, just a building address, that the franchisor you've met the legal requirements for the change of ownership.
I think that's such an excellent point because I see that a lot on a daily basis. And what I think people have to understand is when you are signing the franchise agreements, there is going to be provisions within that agreement, whether it's through termination, whether it's through death, incapacity, or some sort of transfer of interest. And one of the fascinating things, and I'm sure you've seen this as well, is that it really runs the gamut in my experience of what kind of language is in these agreements to account for those kinds of transfers of interest or those kinds of scenarios that arise. I've seen agreements that cover it very thoroughly and account for not only what's going to happen, but if the parties can't come to an agreement, there's a valuation system that's put in place, or at least a process that's put in place. I've also seen it on the other side of the spectrum where there's virtually no guidance and it just says, well, the franchisor gets to take over. Well, one thing I know is that there are franchise statutes in many states that will prohibit that from happening right away. But at the same time, certainly under a franchise system as the franchisor, you have the right to approve a transfer or some sort of exit strategy. But you do have to I think it's a really excellent point that you made, and I think one that's worthy of taking a couple extra minutes on, and that is the fact that as somebody who's looking at this, you can't figure this out, wait till the time for you to exit to figure it out because you've already signed the agreement at that point. So you have to really be thinking about these things at the start of the relationship.
And we ran into that situation down in Tampa with a client. They had already signed the agreement and they thought that they would be able to turn it over to their children to let the children start running the location when he was ready to retire. And the agreement clearly said that the franchisor has 100% discretion on who they want to run or take over a location. And that if the franchisor did not agree with the proposed new owners, they just had to give a 1 year notice, and then the franchise agreement would be terminated.
Wow. And that's major. I mean, that's somebody's business, that's somebody's livelihood, that's somebody's investment. I mean, this is why it is so important to get the good advice before you dive in to these kind of
And
scenarios.
that's right. And so what you look at is when you're going in to evaluate your franchise is how do I get out? What is, and not necessarily if it's in a bad situation, but how do I make my money on the outside of it? Some of the franchise agreements that we've worked around, we will work with the franchisee to actually buy the real estate where the franchise is operated on. And that's that second component, which is looking at how the assets that the franchise has to have in order to operate, be it leasehold, land, equipment, how are those titled, who owns them, are they actually owned in a company outside of the franchise, so that if your franchise agreement gets terminated, you still own those hard assets that you could sell off in order to recoup some of your investment back out if something goes bad with the franchisor.
Now, I really like that because it's basically just an added protection for the franchisee. I mean, the reality is in any franchise situation, the franchisor is always going to have the upper hand. I mean, these agreements are not meant to be equal. That doesn't mean they're not able to be negotiated. It doesn't mean that, there's not provisions within there that are favorable to the franchisee. It just means the franchisor is going to have the upper hand from that perspective. So anytime you can, as a franchisee, position yourself to where you can take back some of that control, even if it's through one of these other vehicles, is a very wise thing to do because it can certainly have a significant impact on these kinds of outcomes.
It does. And that's where when you get into your franchise, you really have to think 5 to 10 years down the road. What is it that you want out of this? Too many times I see people looking at the first 3 years. They say, well, we got to get through the first 3 years in order to make sure that we can make money. That's great. But if you're in a franchise, more than likely you're going to get through those first 3 years, or the franchise wouldn't approve you, because the franchisor does not want to open up a location and then for it to fail within the first 3 years. But you've got to be on the lookout as to how do I get out of this? Or is there an automatic renewal inside of my franchise agreement, or do they have the right not to renew it? And if they don't have the right to automatically renew, then how much money do I want to invest after I've already gotten my initial capital back out? And those are just some of the things that I think a lot of people overlook. They don't look at the exit strategy. They're just looking at the immediate dollars on the front end. And the exit strategy is just more important to me than the beginning.
Well, that's right. I mean, you always have to be thinking with the end in mind. I mean, it's so hard to do. I mean, it's easier. It really is easier said than done. But I think that the reality is that if people are smart in how they're doing their due diligence, they're thinking about, their best case scenario for how this is going to end. And it may not be through a sale. I mean, it may be through passing it on to your children. It may be through having a partner who then just buys out your shares. I mean, there's infinite number of ways for this to happen. But the important part is that you're at least giving it forethought ahead of time, because I think that will help you account for how you're going to address it along the way. Because sometimes if you don't address it, it'll be addressed for you and you may not be happy with it.
Exactly. And that's where when you start looking at your exit strategy, like you said, am I selling stock? Am I going to sell the interest in my LLC? Well, that's a long-term capital gain that's taxed differently than if I'm going to stay on as a consultant and just get paid out on an installment sale agreement some of the profits every year. I mean, there's a huge tax consideration with whatever your exit strategy is. And you may not fully know what that's going to be until 5, 8 years down the road. But if you at least have an inkling of a notion that this is going to go to my children, or I'm going to have to sell to a partner, then at least you begin setting the parameters up at the beginning that says, all right, if I'm going to sell to a partner, then I'm going to have to at least make sure that my LLC allows me to bring in a partner and that the franchise allows me to bring in a partner 3 years, 5 years down the road. Maybe you get that put into your agreement at the beginning, that you have the right to bring in an equity 50% partner down the road that the franchisor will not turn down.
So if somebody wants to find out a little bit more information or seek out your expertise, what's a good way for them to get a hold of you?
They can go to my website. It's tabburkhalter.com, TAB, burkhalter.com, or they can call us at 865-984-4080.
Well, and of course, we'll share all that information in the show notes as well. But thank you, Tab, for coming on and sharing your insight. It's obvious to me that you've spent a lot of time working in this industry, and I think your insights are going to prove to be quite valuable to those that tune in. So thank you so much. I really appreciate it. Thank you so much for tuning in for another episode of Franchise Euphoria. If you enjoyed this episode or have enjoyed the podcast in general, I would really appreciate it if you could go to iTunes and leave me a rating and review. It really helps to get this podcast out to more and more people. So the easy way to do it is go to iTunes and in the search box, put in Franchise Euphoria. You will then see my cover art and you click on my smiling face that says Franchise Euphoria, and then click on the link that says ratings and reviews. It's that simple, but boy, oh boy, does it mean the world to me when people leave ratings and reviews. And like I said, it really helps get the show out there. Once again, would love it if you would go to iTunes and leave a rating and review if you enjoyed this episode or other episodes of the show. And until the next time, happy franchising.